Heard of debits and credits but still confused which one goes where? You're not alone. Most people learn accounting backwards. Today, let's fix that in 10 minutes. Asterisk greater than welcome to Profits and Proofs, where we simplify accounting, math, and business studies for real-world learners. What is accounting? Asterisk accounting is the process of recording, summarizing, and reporting financial transactions. It helps you understand how money flows in and out of a business, like keeping score in a financial game. Now let's study each term of accounting definition in detail. First of all, we record transactions in accounting. Recording transactions means systematic documentation of all financial activities. After recording transactions, we summarize that data. Summarizing data. It means compiling complex financial information into understandable reports. After summarizing data, we create reports from that summarized data. Reporting items means presenting financial performance for decision-making and compliance. Accounting is essential for business decision-making and ensuring regulatory compliance. Why learn debits and credits? Debits and credits are the universal language of accounting. Understanding them unlocks the ability to read financial statements like a pro. Master core accounting principles. Build a strong foundation for advanced financial analysis. Now, let's understand debit and credit in simple word. Debit is the left side of any T account. Credit is the right side of any T account. It's a common myth that debits are always good or credits are always bad. They only indicate a position within the accounting equation, not an inherent value judgment. There are 5 basic types of account. Number 1 is assets. Assets is what the business owns. For example, cash, equipment, buildings. Number 2 is liabilities. Liabilities is what the business owes to others. For example, loans, accounts payable. Number 3 is equity. Equity is the owner's residual claim on the assets. For example, owner's capital. Number 4 is income revenue. Income revenue is the money earned from business operations, for example, sales revenue. Number 5 is expenses. Expenses is the costs incurred to generate income, for example, rent, salaries, utilities. Here's the essential rule to memorize for each account type. If you debit the asset account, it will increase. And if you credit the asset account, it will decrease. If you debit the expense account, it will increase. And if you credit the expense account, it will decrease. If you debit the liabilities account, it will decrease. And if you credit the liabilities account, it will increase. If you debit the equity account, it will decrease. And if you credit the equity account, it will increase. If you debit the income account, it will decrease. And if you credit the income account, it will increase. Now let me explain you these rules with an example. If you buy a laptop for your business, your asset laptop increases. so you debit the asset account. Let's illustrate a simple transaction. You start a business and deposit $1,000 cash. Cash as an asset increases gives debit cash for $1,000. The money Wickham from the onerous Thika Patalowicz increases, so we credit capital for $1,000. This demonstrates the fundamental accounting equation. Assets equals liabilities plus equity. Now, let me explain you another example. Now, let's say your business pays $200 for rent. Rent is an expense increases, gives debit rent for $200. Cash asset is decreasing, gives credit cash for $200. Every transaction affects at least two accounts, maintaining the balance. This is called double entry accounting. There are some common mistakes beginners make in accounting. Don't assume debit always means increase, or credit always means decrease. It depends on the account type. Number 2 is cash versus income. Confusing receiving cash with earning income? Cash inflow doesn't always equal profit. Number 3 isn't balanced transactions. Forgetting that every transaction must maintain balance, total debits equals total credits. Now let us summarize this whole video of accounting basics for beginners. Number 1, debits equals left and credits equals right. Always remember their fixed positions in a T account. Number 2, know your account type. Master the 5 basic account categories: assets, liabilities, equity, income, expenses. Number 3, apply the rules. Understand how debits and credits affect each account. TI pay.e, increase or decrease. Number 4, use T accounts. Visualize transactions clearly and stay organized. Number 5, ensure balance. Every transaction must result in equal debits and credits. If you found this helpful, don't forget to like, subscribe, and hit the bell icon asterisk. I'm Zach. And this is Profits and Proofs, where we turn numbers into knowledge asterisk. See you in the next video.